And welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread, and today we're going to continue our discussion into personal finances for business owners. And as you know, we're starting our conversations into investments. And yeah, we'll get to stocks, bonds, mutual funds, gold, cash, and all that stuff. And I even have a cool episode that we're going to talk about strange investments. But before we get there, as I've mentioned in the last few episodes, we want to cover where to purchase our investments, what a type of account. So we've been dealing with the retirement accounts first, and we're going to deal with some other types of accounts here soon. But in the retirement accounts, we've covered IRAs. We introduced last time the simple 401k. Today we're going to cover the solo 401k. I got to tell you, this is perhaps one of my favorite type of investment accounts. The solo 401k. If you're a small business owner and you do not have employees, I want you to pay close attention to this. If you do not have employees and you're a small business owner, this is for you, especially if you and your spouse run the business. This could be fun. You say, Justin, I do have employees. Should I just tune this out? No, because you're going to be able to pick up some tips here. And next time you're around the water cooler and you're talking with your other business partners, you're going to say, dude, let me tell you about the solo K. I can't do this, but Charlie, Sally, Tim, Samantha, you guys should really listen to this episode on the Financially Simple Podcast. I got to tell you, one of my faves here, folks. Look, someone reached out to me on LinkedIn. They said, hey, Justin, we've been watching your podcast videos on YouTube. That's right. We release these on Stitcher, Spotify, iTunes, iHeartRadio. I mean, it's on like almost every channel out there, and we're getting some pretty cool reviews. By the way, if you like the show, please leave a review. That lets other business owners know about this type of content. I've gotten some really cool reviews, but someone shot me. They saw the video on YouTube, and they made a comment like, dude, why are you always in a white polo? I didn't think about it, but I got to looking at the last few episodes, and they're looking at the video, and they're like, Justin, you're in a white polo again. Look, guys, it's like 175,000 degrees here in East Tennessee right now as I'm recording this. In fact, if I look at my phone, it's 96 degrees outside at almost 6 o'clock in the afternoon. White polos are cool to me. I'm not sweating. Well, so are other colors. I know. I'm kind of boring. I like white and blue, okay? So if you think I need to get a different color, let me know. If there's a shirt that I've worn that you think is really cool, let me know. By the way, on the sidebar, do me a favor. As you listen to this, we're getting ready to order some t-shirts, some really cool t-shirts. And I was thinking on the front of the t-shirt that we should use like #GotWealth. Let me know, is that a cool hashtag? Maybe send me a hashtag in Twitter at Justin Goodbread and say, hey brother, use this hashtag for your t-shirts. Someone said a #FS. I don't know. We want to create a hashtag environment. You know, if you can watch the video right now, you're seeing me do the Justin Timberlake hashtag, right? Just hashtag from one of the skits. It was pretty funny. So anyways, today I want to deal with the business owner's guide to the solo 401k. What in the world is a solo 401k? Well, pretty much exactly what it sounds like. If you're a business owner, as I mentioned before, and you do not have employees, you're by yourself, this is for you. Some people refer to this as an individual 401k. Regardless if you call it a solo or an individual, the Internal Revenue Service pretty much says in a solo K that if you have employees, you can't use it. So that's why we call it a solo 401k. What are the details for this beast, and why do you like it so much, Justin? If you remember back to our SEP IRA conversation, I gave an example that we could contribute up to the maximum of $56,000 into a SEP IRA. You can contribute a ton of money. I think it's $53,000 to the SEP IRA. There's so many numbers in my head. In a solo 401k in 2019, we can contribute $56,000, and there is a catch up of another $6,000 if you're over the age of 50. Yeah, you could put back $62,000 of your income and not pay federal income taxes on that. It's pretty amazing to me when you think about it. In some states, you don't have state income taxes on the numbers. It's pretty amazing to me that you can put back $62,000 of your income. Why does that matter? Well, if you're maybe in the scenario where you're a married filing jointly family and you and your spouse work in your business and you now made $390,000, as many of our clients have, then we can pull that number down through profit sharing provisions of a solo K, we can pull that number down and potentially have you eligible for QBI deduction. And again, that's a CPA's world. They're going to show you how to record all that. But you can use it to minimize your taxes. You can actually use it to bring your adjusted gross income down into below thresholds, below phase-out rule numbers in the Internal Revenue Code. Not to mention, that's a heck of a lot of money to squirrel away for your one-day retirement. So in order to understand the 401k, you have to think of yourself, the solo 401k, you have to think of yourself as two people. You have to think of yourself as you, the employee, and you, the employer. Yeah, you're the same person, but you have to consider yourself two different provisions. You see, as you, the employee, if you're under the age of 50, you can put $19,000 in. If you're over the age of 50, you can do $25,000. That's the employee contribution. But the employer can also give you money. They can give you money as part of the profit sharing contribution. How the profit sharing works is pretty similar to the SEP IRA contributions. So in a profit sharing, you can contribute up to 25% of your compensation or net self-employment income. 25% of your compensation or net self-employment income. Net self-employment income, by the way, is which is your net profits less half of your self-employment tax and the plan contributions you make for yourself. So that's a calculation that has to be done. But it's important to show that because you can place a ton more money into a solo K, and we're going to talk about this in a second, than you can a lot of other plans. So you can make a contribution from you, the employee, of $19,000, and you can make a profit sharing contribution, let's say 25% of your total compensation or 20% roughly of your net income. That's kind of how the numbers work out, of your business profits. So you can put both of those monies into the 401k. The solo 401k. If you remember the SEP IRA, which I mentioned a few episodes ago, the SEP IRA, you could have about the same thing, but you didn't have the employee contribution. You can only do the employer contribution. So I like the solo K because it allows us to put more money into the plan than a SEP traditionally will. There's also one other rule. One other rule that many people, in fact, I've even ran on many CPAs who didn't even know this is eligible. Actually, I had one CPA that argued, defensively, red-faced argued with me that, dude, you don't know what you're talking about. Now, granted, that individual never actually opened up the Internal Revenue Code and read the document themselves, which is frustrating to me that you call yourself a CPA and tax preparer and a tax compliance officer and you haven't even opened the IRC. Nonetheless, calm down, Justin. I was able to show this individual that you could do this really interesting thing. If your spouse does not work in the company, your owner spouse is eligible to participate. Self-employed individuals and owner-only businesses and partnerships are eligible to include the owner's spouse in the 401k plan. You could virtually double your retirement savings. Let's go back to our mythical conversation here. You have somebody here that's making somewhere in the neighborhood of $100,000, $200,000, $300,000 in your 401 inside your business. And you're like me, you live pretty frugally. You don't need as much money, and you certainly don't want to pay the IRS. What you can do is you could theoretically, depending on your age, if you're over the age of 50, put $124,000 into a retirement account that's not federally and many times not state taxable. That is huge. In fact, we had this case last year where one of our clients, they watched the real estate run up and they had some really good properties that we had helped buy in various different types of accounts. We're going to come back to that to later, but they wanted to sell them. Some of the properties generated taxes, recapture tax and capital gains and some other taxes. We used the self-employment rules. This individual was self-employed. They did not have any employees. We used the solo 401k and made contributions for the business owner and their spouse, socked in literally over $120,000 of money. Their pre-tax, before this contribution in place, their tax bill was going to be roughly in the neighborhood of about $65,000. After all the way it worked out, the CPA recorded the contributions to the solo K, and the way it all worked out, their tax bill dropped from the mid $60,000s down to about $12,000. That is huge. That's $40,000 they didn't give the IRS. Okay, so I love the solo K because especially if you're single, especially if you're a single owner or you and your spouse run your business, you're a mom and pop and you're employing a bunch of 1099 employees. The solo K is like rock star status, folks. It's amazing what you can do to build wealth. Not only build wealth, but you can also get rid of the IRS and pay less in taxes if you use this thing right. So that's one of the biggest reasons why I like the solo 401k. Another reason that I like the 401k is the solo 401k is you can combine it with other 401ks. So let's say that you're gigging on the side. You have a side gig and you're making some money. Let's say you're driving for Uber or Lyft, or you're writing for Financially Simple. You're doing video editing for Financially Simple, the podcast here. Even Adam, the individual that we just adore, who does all of our podcast editing for us. If he were in the United States, and Adam, he has this funny accent, guys. He's like from over the pond over there. He's probably chuckling when I say that. But if he lived in the United States, the income that we pay him could actually be utilized for a solo 401k. And let's say he was working at a job that also offered a 401k. You could use both of them. You can actually make contributions to your day job in your 401k, and you can make contributions to your solo 401k. Here's where it gets interesting. You have to make sure they correlate. You have to make sure that they participate. You can't put more than $19,000 into the combination of both. But you can do some profit sharing in your solo K. So let's say you come over here in your job and you max it out at $19,000, but now you also have $100,000 in net income on your side hustle. You could put in theoretically $25,000 or $20,000 as profit sharing. It's amazing how you could use these things together. So the solo K is going to combine with your other 401ks. Now, once you get this plan moving, as so many of our clients do, and you make more and you have more than $250,000 in assets at the end of a year, the IRS is going to have you file Form 5500 SF. Form 5500 SF. It's basically a simple form that you let the IRS know what your contributions were at the beginning of the year, what your account balance was at the beginning of the year, the account balance was at the end of the year, how much money you made in account how much you contributed to the plan, and what your fees were. It's a short form of a 5500 form. 5500, as you remember from last episode, is a document that a 401k has to file for compliance reasons. A solo K has to do the same thing when you have more than $250,000 into it. Another thing that I like about the solo K is this. You can contribute the profit sharing or the employer's contribution after the end of the year. Now, if you remember the SEP IRA, you could do the same thing. The SEP IRA, you could actually set up an account and fund it within the same month that you actually file your taxes, all the way up until October 15th. Solo K is a little different. You actually have to have the plan established before December 31st. So let's say we're in 2019. I have the idea that I'm going to use a solo 401k. I actually start the 401k and I make my employee contributions before December 31st. But you know how bookkeepers are. They really don't know what the final numbers or the profit's going to be of the company. So now you don't find out what the final numbers are going to be until September 1st, before you have your September 15th extension filing date. You now can go in and make your profit sharing contributions to the solo 401k all the way up to the time whenever you're contributing by the deadline of your tax year, your tax filing. So your employee contribution has to be made by year end. Your employer contribution can be made for the deadline of your tax filing for that particular entity. It's a little interesting caveat there that a solo K allows. Just remember, if you want to set up a solo K in 2020 for 2019, it ain't happening. You got to have it in place in 2019 to use it for 2019. Another thing you can do with a solo K is you can create a loan provision. I cannot tell you how I love to have a loan provision on a 401k. You can borrow money from yourself and you can pay yourself back interest. Now, is it wise to use the loans? It depends. Depends on what you're trying to do. It's not a bad strategy. For example, I have several business clients that have UCC1 filings on their practice notes. So they bought practices, dental practices, optometry practices, veterinarian practices, law practices, engineering practices, lots of professionals that we work with. They'll go borrow some money and the bank puts a UCC1 filing, in other words, a blanket lien over the whole practice. Whenever that happens, whenever you have a blanket lien, it eliminates some of the more advanced tax planning strategies we can use because of trader business income, et cetera, et cetera, et cetera. That's a whole nother conversation for another day. If I want to get rid of a lien, I can go into the Solo K and borrow $50,000. So the rule on borrowing money out of a 401k is this. You can borrow up to $50,000 or half of your account balance. So let's say you have, I'm doing this in my head super fast. Let's say you have $60,000 in your account. You can borrow $30,000 out of your account. If you have $200,000, you can only borrow $50,000 out of your account. And you have to pay your account back with interest over at least no longer than 5 years. You can pay it back sooner, but you have to pay it back within 5 years. Unless you're using the money to pay for a house. Then you can actually spread it out over to 15 years. I actually learned that little trick this last week. We were trying to solve a client's problem. I didn't realize that. Honestly, I didn't realize you could have a different loan payback on a 401k loan than you did to borrow money out of your 401k to, let's say, buy a piece of equipment or use it to pay off a practice debt or something. So the Solo K, we can actually create a loan provision from the Solo K. I love it. One of the things that I love about a Solo K is that you can make it ROTH eligible. Go back at the beginning of the conversation. I said one of the things on the Solo K you're going to have to think about is you, the employee, versus you, the employer. You, the employee, can put $19,000 or $25,000, depending on your age. Remember, under the age 50, you can do 19. Over the age of 50, you can do 25. You can make your contribution Roth IRA. Go straight into the ROTH 401k provision. That's right. You make $300,000 and you're phased out on your Roth IRA. You can put it into your Roth 401k. But then the company's profit sharing provision goes in pre-tax. Always goes in pre-tax because the company's going to get, or you're going to ultimately get a tax deduction for that. But you can use a Roth on a solo 401k. Love it. Love it. I got to tell you, the solo 401k for so many of you would revolutionize not only your retirement plan, but your tax plan if you did it right. Dude, you're like crazy excited today. Man, I can't tell you how much the solo 401k stokes. It's just amazing to me because I've seen the power of utilizing this, especially in a spousal type of relationship, especially for tax planning. There's some crazy things we can do. So how in the world do you open up a solo 401k? Believe it or not, it's not hard. You're going to need an employer identification number. You will need an EIN number. More than likely, you'll have one. But if you don't, you'll need an employee identification number. But most brokers can open it. In fact, we manage a fair amount of solo 401ks. So they're pretty easy to open. Not hard. My first solo 401k I opened with a mutual fund company. This has been years and years ago before I had employees. I had a solo 401k that had a mutual fund company and they administered the plan for me. And I just made my contributions and bought my investments and so forth, so on. Then we used TD Ameritrade as our custodian. Then I moved my plan to TD Ameritrade and they served as my custodian. There's all sorts of custodians you can use out there, but it was so easy to do, was my point. And you can buy so much stuff in the solo 401k. You can buy stocks, bonds, mutual funds. You can buy exchange traded funds. You could even self-direct. Yeah, we're going to talk about self-directing. I'm trying to get a special host, a special guest in on the self-directing portion and why it makes sense, why it doesn't make sense to self-direct. But you can self-direct your solo 401k. Some crazy ways to do that. So I hope I've at least piqued your interest into yet another type of account that you can use to build your wealth. Remember, taxes, man, as Chris Mahan, some episodes a long time ago said, and I'll never forget it, the Internal Revenue Code is one of the greatest wealth building tools we have at our disposal here in the United States. But so many people are scared of it. The Solo K is a way that you can eliminate some taxes and build wealth. It's a way that you can eliminate interest. If you use a loan provision and build wealth, You could even eliminate some insurances if you did this thing right and build some wealth. I hope this helps you. I answered the question about why I'm wearing a white shirt. I got that. If you're watching me on video today as I keep hitting the stupid microphone in front of me, you're probably also seeing where I got sunburn on the lake this last week. Look, life is hard. We work long hours as business owners and we bust it. We play hard too, by the way. I tortured my nephews this last week on the lake during the holiday season. It was outstanding. I loved it. They were like, "Oh, Uncle Justin, you." I was like, "That's right, suckers. It's all in the Cabbage Patch. Come get you some." Life is hard. We play hard. We live hard. Life just is hard sometimes, but life is good. Life is so good. We live in the greatest country in the world, in my opinion. Feel free to make it yours because I'm right. We live in the greatest country in the world. Adam, no offense, brother. United States to me is the greatest country in the world. Yeah, it has its problems, but man, life is so good. Life can be frustrating. Trying to pick out all these different types of investments, investment accounts, they can be frustrating. Money doesn't have to be frustrating, folks. I hope you're starting to see that. Let's continue to make our lives at least financially simple. Y'all go out and make it the best day you've ever had.